Welcome. Good day to the ADK and Financial Planning World community. Dan Davis, President and Co-founder, coming to you from the beautiful Marco Island JW Marriott. Reason we're here is LPL is hosting a Masters Conference, which is basically a reward incentive for the top 2% of the people within the company. So ADK's been here 26 times, hard to imagine. The market update focus today is really looking at the first quarter and unwinding some trends, talking about what we think is going to happen for the rest of the year and looking at some of the potential headwinds. So if you take a look at what's going on, it's a continuation of 2023, where you've got a few key U.S. large growth companies, we'll call it the Magnificent Seven, doing so well that it's driving an entire index. Now, those trends in my 36 years doing this are not sustainable. At some point, they turn. No one can really predict when that happens because it's almost as though, as Schiller puts it, there's this animal spirit that goes on. And what it really boils down to is greed goes way beyond fundamentally what should happen, drives things to valuations that are frothy to ridiculous, and I would say we're there now. That it's just at some point you don't know, does the end mean that the categories that have been driving it the hardest plummet, and stuff that hasn't done as well drops, but not as much to where the gap in valuation corridor is now normalized? Or do the things that have been doing really well go sideways and the other stuff catches up? Like I said, no one can predict that. The trends and tactical things that we've been doing basically allows us to say, okay, in 2022, because the markets had done so poorly, we pushed a lot of money into stuff like semiconductors, and we all know the names of the companies that have been doing extraordinary in that space. Well, one of the things that we did most recently was we took our semiconductor position and we cut it in half. One would ask, well, if that's your best performing asset, why would you do that? And it gets down to what we were just talking about. We don't believe that the valuations are sustainable. We believe taking some of that money off the table is wise, but we don't know, will it end in 2 days, 2 months, 2 years? And we're still very bullish long-term for semiconductors because they, as you've heard me say, are the equivalent of oil to the economy in the 70s. Semiconductors is that now. So long-term bullish, took some money off the table there. Another thing that we did was, you've heard the phrase Magnificent Seven. One of the investments that you held that we had put in play last year primarily holds all the Magnificent Seven. Well, we sold that. It's very NASDAQ index heavy, and we turned around and bought into just a really solid U.S. Value, and then we also bought Japan. Why Japan and why U.S. value? U.S. value is that category that we are looking at paying really strong dividends. The valuations are very reasonable, very low compared to the growth. Why Japan? Japan's really benefiting a lot from the capital markets moving away from China, and they're staying in Asia. They're going to places like Japan, Vietnam, etc. Japan's market is at an all-time high. Some would say, well, why would you buy something at all-time high? It's broke through some real significant resistances that it hasn't been able to break through for decades. And there's just mega trends that are happening that we're very solid and bullish for. Plus, we're super underweight international as it stood before that. Another move that we made very early in the year, last year, beginning of the year, we added defense as a tactical play because of all the wars and munition expenses and bombs, etc. Well, when Hamas attacked Israel, we doubled that overall position. It went up about 18%. Year to date, it was in negative territory after Boeing's door fell off. So we essentially said, let's just take our profit, cut our position back in half, so we're not nearly as overweight in defense as we were before. And again, that went to a healthcare, U.S. healthcare. Why healthcare? If you break the S&P 500 into 11 subcomponents, you've got basically information technology, you have all the things that the Magnificent Seven would fall into. Communication services are those two categories. You also have things like real estate, utilities, And then the two that are running the best compared to the tech is healthcare and financials. So we wanted to have a healthcare play. Healthcare play is more of an intermediate move. I don't think that it'll be in the model long term, but it certainly isn't there for a short term play. The beginning of the year, our market update, we said we thought that the stock market would do somewhere between 8 and 12%. We're on track for that and still hold that to be our thesis. The thing that's probably the biggest surprise to most is the bond market. U.S. bond market's in negative territory for the year. Why is that? Well, first, the Fed last year said they were going to be stopping raising rates, which they have. The market then assessed from their interpreting Fed minutes and all that the Fed would lower rates 5+ times this year. The Fed in their dot plot was more saying they probably would do it 3. LPL's research team thought it'd be 3 or 4. So clearly there was a disconnect. And so the Fed controls the short-term lending rates to banks, but then the marketplace determines the rest of the yield curve. And so the yield curve was a little bit overzealous when Powell made some of his announcements that it made it more clear he wasn't going to be raising rates in the first quarter. Then the interest rates rose on the yield curve, hurting bonds in the short term. But our thesis and belief on bonds making 4 to 6% still holds. So what are some of the major headwinds that could cause our outlook to fall apart? Really boils down to geopolitical. Whether it's stuff like Russia with Ukraine, China with Taiwan, North Korea acting up, or this thing that you're starting to hear about, the axis of resistance, where Iran and the Shia Muslims are doing radical Islam type stuff. And you take a look at the Red Sea. The Red Sea is a place that much cargo traffic that's shipping comes through to go through Egypt, the Suez Canal, and then it gets shipped all over the world. Well, obviously the headlines are showing that a lot of stuff's having to avoid that, and it's creating a lot of tension, increased costs, et cetera. So any of those things could flare up. What I found interesting about this concept of the axis of resistance, really led by Iran, I have to say I don't really know that much about the Islamic turmoil between Shia and Sunnis, but clearly what you're seeing is the Shia, Iran, a lot of their allies, you're now starting to see the Sunnis, places like Jordan, Egypt, et cetera, signing treaties with Israel, which you would have never thought that would work. But what it really boils down to is the Sunnis and the Shiites hate each other, and right now Iran is really just a huge threat. In Joel Rosenberg's Enemies and Allies, a book, if you like those types of reads, it's fascinating about how he's talking about all these allies that you wouldn't think would come together to work. So when you're seeing the Sunni Muslims come together with America, Israel as allies, that's part of this whole axis of resistance. And it's, like I said, it's one of those real big geopolitical things that just no way to predict what Iran's going to do, because it's my belief that Iran is so hard for us to imagine, because they believe that if they were to blow up the world, that would usher in this next stage of Islam that would be something that would be rewarded in heaven, which is just bizarre for us as Westerners to even contemplate. So biggest headwind to me is the geopolitical risk, impossible to measure. We have a disaster plan in place that if something crazy happened, we would take significant equities off the table. We still would get hurt. We wouldn't. It's not like we would avoid it. It's just we would be doing loss minimization and whatnot. Thank God for electronic trading is all I can say. But more on that in one-on-one conversations if that's of interest to you. There's other risks, but none of which I would even categorize close to what I would say is the geopolitical risk. So wrapping it all up, I'd say outlook looks good, going to be choppy. We're in a position where the geopolitical risk is hard to measure, but we think that the bond market, stock market, both have really favorable returns in front of us. Obviously, investing has risks, so you never really know, but our outlook for the bonds, 4 to 6, outlooks for the stocks, 8 to 12, and we'll keep you posted along the way. So from this beautiful balcony looking out at the ocean in Marco Island, we will bid you farewell and see you soon. Have a good rest of the day, and thanks for your time.